Welcome back to BetaShares Explains ETFs. Lesson 3, how ETFs are priced, bought and sold. In this lesson, we'll explain what happens when ETFs are bought and sold, how they're priced, and the ideal time of day to trade. Ready? Let's get started. ETFs are bought and sold on a stock exchange, such as the ASX. They are traded in the same way as shares in listed companies, such as CBA or Woolworths. Each ETF has a unique ticker symbol or code. For example, BetaShares Australia 200 ETF has the ticker A200. When searching ASX data for the ETF you want to trade, either directly with your broker or directly with the ASX, typing in its code will bring up the right ETF on screen. Now, let's take a closer look at how ETFs trade. Investors usually interact with a broker when buying an ETF, but behind the scenes, there are other service providers involved in the trade. These include the ETF manager, such as BetaShares, a market maker, a broker, such as CommSec, and of course, the stock exchange. Look at an ETF like it's a bag of marbles, say a collection of 200 individual stocks, including the largest companies listed on the ASX. The process starts with what's called the creation mechanism. This involves a market maker who collects the marbles in a bag and passes them on to the ETF manager, such as BetaShares. In exchange for this bag, BetaShares provides the market maker with ETF units, that is, units in the fund, which are then available for distribution via brokers on the ASX to investors like you and me. There are a couple of benefits to the creation and redemption process. Firstly, it enables ETF to have liquidity, making them easier to buy and sell when investors want to. Secondly, it works to ensure an ETF's value stays closely aligned to the value of its underlying investments. ETF pricing works differently to pricing company shares. There is a limited number of shares in a listed company, whereas the number of units in an ETF can vary. Company share prices fluctuate based on a number of factors, including supply and demand from investors. However, ETF prices are calculated according to the net asset value, or NAV. The NAV is the value of an ETF's underlying assets. That's not to say supply and demand doesn't affect the value of an ETF. It can, but the effectively unlimited supply and the creation and redemption mechanism of ETFs are designed to ensure that an ETF's value remains as closely aligned to its underlying investments as possible. It's important to note that at times an ETF's NAV may differ from its market price, which is the price at which investors can buy and sell an ETF on the exchange. This is most likely to occur when markets experience significant volatility, including at the start and end of each trading day. So, how can you tell if an ETF is trading at fair value? One way is by checking its market price and its NAV are similar before buying your units. Some ETF managers, like BetaShares, provide real-time indication of an ETF's NAV on their website, shown as the INAV or indicative net asset value. The first and last few minutes of the trading day are the ASX peak hour, when there can be significant price volatility. It's generally best to purchase ETFs when the market has settled, usually between 10:30 a.m. and 3:30 p.m. Sydney time. Thanks for watching Lesson 3, where we discussed what happens when you buy and sell ETFs, how they're priced, and the ideal time of day to trade. Lesson 4 is coming right up.